About 18 months ago, I posted a video about Cathie Wood's ARKK ETF and her other ETFs also, telling you why these ETFs over the long term are not going to beat the market and are going to crash. This is exactly what happened. Since I posted that video, the ARKK ETF is down by over 60%. And Cathie Wood, all her portfolios, all her ETFs are not beating the S&P 500 over the long term and are not beating Berkshire Hathaway since inception. Of course, at the time when I made that video, it was quite controversial because you look at her returns, they were great, and people were expecting that she will keep beating the market. At the time, what I talked about was the problems with these ETFs. For example, I talk about redemption. But today, what I want to talk about is not the ETF itself, but the strategy that is used by Cathie Wood. Because of her strategy, that's why she's failing to beat the market. She is a growth investor. And the main strategy that she uses is to invest in companies that she says in the future are going to disrupt an industry. So if she's investing, for example, in Tesla, it's because she sees that Tesla over the long term in the future is going to disrupt the auto industry, is going to disrupt the energy industry. This is why she's investing in the company. So this is purely growth investing. Growth investing is about investing in companies today, expecting that they will keep growing over the long term, and you're investing for these reasons alone and not because of valuations. What you expect is that because the company will keep growing over the long term, investors, not you, other investors are going to buy shares of this company, putting a higher price on the stock. So if, let's say, an example, the company is profitable today, it has $10 million in income every year, and you think because of this growth potential, normally when we are looking at growth stocks, because of this growth potential, investors are going to put a higher premium on the stock. So the PE ratio will not be around 10, maybe it can be about 30. So for $10 million in profits, let's say the company has a market cap of $300 billion. And we are right. In 5 years, the company has 10x its profits. So now it's no longer $10 million, it's $100 million. So what will be the PE ratio? Then we don't know, of course. But according to these investors, let's say it's the same, the market looks at the stock the same, it is going to be 30. So 30 times 100, that's $3 million. So even the stock, it has 10x in value. It is a 10 bagger. So this is how growth investors look at stock. So it's not really about the valuation, it's about the multiples, how much investors are willing to pay for these stocks. And most of the times, they don't want the multiples to stay the same. They want it to keep growing. They expect that if really the company can grow its profits over the long term, then investors maybe would want to pay not 30 times earnings, but 40 times earnings. Then it can be more than a 10 bagger. You see the problem with this strategy? I'm not telling you that growth investing is bad. It can be good, but there is a problem if we use purely growth investing. Warren Buffett said that there is no such thing as growth investing, value investing. Even I invest in companies that I expect are going to grow, and I look at multiples. I can invest in a company. The company today is not making that much money. Maybe it's even losing money, but over the long term, I expect things will be better. But it's all based mostly on fundamentals and valuations. For Cathie Wood, the growth investor she is, valuations, fundamentals do not matter. What matters is that investors over the long term are going to pay more for this company than they are paying today. So this is what we call the smarter fool. You are a fool buying a stock just because the price is such and you expect it to be higher. But why you expect it to be higher is because there is a smarter fool who's also thinking like you, who will buy the stock from you in the future. And that smarter fool also expects an even smarter fool to buy the stock from you until we run out of fools and everything crashes. This is the strategy that is being used by Cathie Wood. And I'm not really making fun of her. This is what she says. You can read what ARK Invest writes on their prospectus. This is their strategy. This is how they invest. And even the company they're investing in, they're not really looking for profits now, but profits over the long term. What I dislike the most about her strategy is the way she analyzes companies and the way she looks at risk. This is why she's losing money, the way she looks at risk. almost every of her investment, she will give you a bear case, a bull case, and the base case. Most investors do this, even I do this. But my difference with her is that my bear case is not a 10-bagger. For her, it is. Even when I look at GameStop, my best ever investment, when I first looked at the company, it was in September 2019, I made an analysis. I look at different scenarios of what may happen or may not happen. At the time, of course, I was not considering the short squeeze that happened later. So the company, of course, had a lot of debt. And I said to myself, there is a possibility the company files for bankruptcy. So I put a 5% probability it files for bankruptcy. Those short sellers of GameStop, they were right to think that the company can go bankrupt because really the business was failing. But of course, they did not read the income statement well. They did not consider that free cash flow was positive and there was a next console cycle coming. The company was also buying back shares. But it's okay. These people, they have a point of view and it's okay to think that the company will fail. It is okay. But what's important to talk about is that I look at multiple scenarios. The bear case, the bull case, and the base case. And in the bear case, the company was going to file for bankruptcy. So the investment I made in GameStop, it was going to zero. And I put a 5% probability that this happens. If you're interested, you can read the full analysis of GameStop I have made. I have talked about this company so much, how I saw that there was going to be a short squeeze, why I invested the company, why I decided to sell at the price I sold. Everything is available on my research platform, along with my investing course for beginners. So if you're interested, please have a look at it. I've also made videos about GameStop and it would have better if more people watch my videos. So please make sure to smash the like button so that it spreads throughout the YouTube universe. So I can invest in the company. There is a 5% probability I lose everything. This is a risk I have to take. And then I put 10% probability of a certain price, 20% a certain price. So this is what I usually do for any investment. Of course, I calculate the intrinsic value. This is the first step, to calculate the intrinsic value. If it is undervalued, then only you do this exit multiple strategy. You look at different scenarios of what investors may be willing to pay on the stock in the future. Let's say in 5 years, in 10 years, depending on the stock. For some stocks, it can even be 1 year. And the bull case for GameStop was that it was going to be a 5-bagger. Gradually, as I understood the company more, as I saw that they were buying back shares, they were repaying their debt, everything that they were doing, and buying back shares could lead to a short squeeze, my analysis of GameStop changed. Now that 5% probability that the company goes bankrupt in that period of time was no longer here. Why? Because they had more cash than the current market capitalization, more net cash. So they could even repay all their debt. So I was not worried that the company files for bankruptcy anymore. A company without any debt cannot go bankrupt. But it was still possible that the company stops their operation because the business is failing and they decide to stop operation. This is not bankruptcy. You can still lose everything. So I readjusted my analysis. This is something I do for any of my investments. And every investor in the world, they do the same thing. But the difference with some growth investors, such as Cathie Wood, is that even their bear case, it looks like my bull case. You look at her thesis for Tesla. Or even Zoom. Zoom is more interesting because Zoom is her largest position right now. It used to be Tesla, now it's Zoom. We don't know what it will be next year. But for every of her big positions, it's the same story. So her bear case for Zoom is that Zoom is going to be a 10-bagger. So she doesn't even consider the possibility that the investment she's making can go to zero, which is real. I'm not telling you that Zoom will go to zero, but there is always this scenario. What you do as an investor, you look at all scenarios, especially the worst ones. The worst case scenario is more important than the best case scenario. I put more emphasis on the worst case scenario. What happens in the worst case scenario? If let's say I'm investing in a company and there is a 30% chance it goes to zero, the company files bankruptcy. Should I invest in such a company? Maybe I can invest, I can take the risk if there is also the possibility it is a 10-bagger. But how much of my portfolio should be in the company then? It cannot be 10% of my portfolio because there is a 30% probability it goes to zero. And you always need to take a margin of safety, which is not something done by the purely growth investors. And Cathie Wood is not alone in this. There are other growth investors who did the same thing. There was a hedge fund in the 1990s, the late 1990s, called Long-Term Capital Management. I think there were even Nobel laureates involved. There were physicists, so they were very smart people. They set up a strategy to beat the market. And they were able to beat the market the first few years until the hedge fund crashed. This is something that is usual. So their strategy was in such a way that they cannot lose money. So any strategy that you build about investing where you cannot lose money is a wrong strategy. It doesn't matter how good an investor you are going to lose money. Maybe the investment in which you have the biggest conviction is going to be the wrong one. You can lose money. Warren Buffett has lost money in Kraft Heinz. He lost money in other investments. Carl Icahn recently lost money in Hertz. So any investment you're making, you have to consider the scenarios where you lose money. And in some of them, it's the scenario where you lose everything. Always, you as the investor, if let's say you are buying an ETF, an active ETF, or investing in a hedge fund, copying someone on eToro, make sure that they are not promising exorbitant returns. Anything that is more than 15% should be considered exorbitant, in my opinion. You can look at an investment, say, I believe this can yield 20% a year, 30% a year. But also, they have to present the case, what happens if it goes to zero? And the overall portfolio should never have an expected returns of 20%, 30%. Maybe the investor can have 20%, can have 30%. It is possible. I'm making 50%, but I never said I was going to meet over 50%. It happened. And maybe it will keep happening. I hope it will keep happening. But this is not what you show on a thesis. This is what you expect you can do. Whenever you are putting a thesis out, you look at a conservative case. Of course, I invested in GEO Group. I hope it can have a short squeeze. If it has a short squeeze, let's say it can be a 5-bagger. I hope it happens. But I'm never going to write about this telling you that GEO Group is going to be a 5-bagger. Because this is the best case scenario. And this is not what you have to expect. You expect the base case with an emphasis on the bear case. And the bear case cannot be a bull case. So if you're interested, please watch this video about GEO Group and why I believe it can have a short squeeze. Have a nice day and goodbye.